Paying $0 in federal income tax is relatively easy if you're on the path to financial independence and early retirement. Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. Let's go ahead and jump right into the numbers, okay? So I'm gonna be giving you how much income you can make, and this is a maximum, and still pay $0 in federal income tax if you're saving a bunch of your money for financial independence, for retirement, for early retirement. Okay, so I'm gonna be using the single and the married filing joint tax statuses. And I'm also going to be using the same ones, but if you are over the age of 50, because you have some special privileges when it comes to contributing more to retirement accounts. All right, so this first figure that we're going to be using is gross income. This is basically the amount of income you make before anything is taken out, before any taxes and deductions are taken out of your paycheck. For the single person, they can make up to $56,000. A married filing joint can make double that at $112,000. If you're single and you're above the age of 50, then you can make up to $64,500. And if you're a married filing joint and both of you are over the age of 50, then you can make up to $129,000. Now we're going to take away your retirement contributions, such as your 401k or 403b or any other workplace-based retirement plan. Okay, so what's going to happen is you're going to take your gross income, then you're going to deduct what you contribute to your 401k or equivalent, and then you'll get some kind of net income after that. So if you are contributing the maximum amount allowable to your workplace retirement plan, this year it would be $23,000 if you're single, $46,000 if you're married filing joint, because there's two of you working and contributing. And then if you're single and above age 50, you get a catch-up contribution that is worth $7,500. So therefore you can contribute up to $30,500 total. And if you're married filing joint and both of you are over the age of 50, then you can double that catch-up contribution. So that's a total of $15,000 extra. That makes a total of $61,000 that the couple above age 50 can contribute to their 401ks. Now really quick, in this video, I'm showing you how much you could possibly make, like a maximum amount, and still pay $0 in federal income tax if you're saving for early retirement or regular retirement. However, I also have paid $0 in federal income tax last year. And if you're curious to know how I personally did it, I do have another video that I want to share with you at the end of this video. All right, but getting back to our math here. So after we take out the 401k, we'll have what we're going to call net income. So it's technically not net income or not technically take home pay because you will have other deductions from your paycheck. But let's go ahead and for simplicity's sake, let's take a look at this. So after we take your gross income and we subtract out the 401k, this is what we have left. The single person has $33,000 left. The married filing joint couple has $66,000 left. The single person above age 50 has up to $34,000 left. And the married filing joint couple that is above age 50 has $68,000 left. However, we're still not done here. In order to avoid taxes, the example people here are going to have a high deductible health plan, which means they are eligible to contribute to a health savings account. And by doing so, they are able to shield more of their income from taxes by putting it into that account. So this is how much they can contribute this tax year. The single person can contribute $4,150. The couple that is married filing joint and they both are eligible for an HSA can do double that, which is $8,300. And it's the same amount whether you're single or married filing jointly over age 50. You still have that same contribution amount. And if you think we're done contributing to investment accounts and retirement accounts, you are very mistaken. We still have more to go. But before I get into that, I just want to say that I put a lot of research and effort, looking up all these numbers and putting them together and doing the math and figuring it out. And I would really appreciate if you showed me your appreciation by just hitting the like button on this video. All right, now the next thing that they're going to put money into is their traditional IRAs. The reason they're going to be doing that is because they still want to reduce their income tax burden. So they're going to reduce their taxable income by contributing to a traditional IRA because their main objective is to pay $0 in income tax. This is how much they can contribute this tax year. A single person can contribute up to $7,000 into their traditional IRA. A couple that's married filing jointly can do double that at $14,000. A single person that is above the age of 50 can do an additional catch-up contribution of $1,000, so therefore they can contribute $8,000. And if you're married filing jointly and both of you are over the age of 50, then you can double that catch-up contribution of $2,000. So therefore, your total contribution can be $16,000. Both of those previous accounts that they contributed to, the HSA and the traditional IRA, are going to be adjustments to their income. So after they get their take-home pay, they're going to adjust their income down to find their taxable income. They're going to adjust it down by how much they put into the HSA and how much they put into their traditional IRA. So let's find out what their AGI is, their adjusted gross income. Well, the single person, if they started with the maximum income, their adjusted gross income is now $21,850. The couple that is married filing jointly is double that at $43,700. And the single person above age 50 also has the same as the regular single person at $21,850, and the same with the couple that is married filing jointly and above age 50. They also have an AGI of $43,700. Thankfully, they do not get taxed on whatever their adjusted gross income is. They get taxed on whatever their taxable income is. And in order to find out what their taxable income is, we need to take some deductions. But before we get onto the deductions, this leads me to the big question here. I want to know from you in the comments below. Does this scenario sound like something that appeals to you? Do you want to pay $0 in federal income tax by maxing out a lot of these retirement accounts so that you have a low amount of taxable income? Could you live on a low amount of taxable income, therefore a low amount of spending if you're saving for early retirement or for regular retirement? Please let me know your thoughts in the comments below. I'm really curious to hear what you have to say. And now getting on to the deductions. In order to make this easier, we're going to be using the standard deduction for this tax year. So the standard deduction is the amount of deductions that pretty much any taxpayer gets to take against their adjusted gross income. So the standard deduction for the single person is $14,600. For the couple that is married filing jointly is double that at $29,200. If they're single and they're above age 50 and they're married above age 50, they get the same standard deduction. And now the creme de la creme, the taxable income, the amount that they're actually going to be taxed on. So remember the initial amounts that they started with, right? A pretty good, decent amount of income, right? They have a pretty high amount that they can possibly make, and that's their maximum, and still pay $0 in federal income tax. So this is what we're left with. After all of those contributions to their 401ks, to their IRAs, to their HSA, we are left with a taxable income of $7,250 if they are single. The couple that is married filing jointly has a taxable income of $14,500. And it is the same for the single above 50 and married filing jointly above 50. By having this amount of taxable income, all of them are put into the 10% marginal tax bracket, which means that they're going to pay 10% on the amount that they have taxable income. The reason why they're going to be paying a $0 federal income tax is because they are then going to take a tax credit known as the Savers Tax Credit. And the reason that they can take the Savers Tax Credit is because their adjusted gross income falls under the limit on which they are allowed to take the Savers Tax Credit, and the amount that they qualify for eliminates their tax bill completely after figuring out that 10% marginal tax rate. So not only were they able to reduce their net income by contributing to a workplace retirement plan, they are also able to take adjustments to their income by contributing to an HSA and a traditional IRA. And then they're able to take the standard deduction to reduce their taxable income to be very, very low. And then once they figured out their tax bill, they were able to take a tax credit because they contributed to these retirement accounts. So what this really means is that the IRS wants you to contribute to these retirement accounts. They want you to grow your wealth and get rich and retire early because they are putting all these incentives in place for you to do so. And by doing so, you can make a pretty decent amount of income and still pay $0 in federal income tax. The way that I paid $0 in federal income tax is a little bit different. Okay, so last year I did have a $0 tax bill, but I had a much more complicated tax situation than this example that we're working with here. And if you're curious to see how I paid $0 in federal income tax, boy, do I have the video for you. Okay, it's gonna pop up right here on the screen right after I get off of the screen. And I'll also put it in a link in the description below and in the pinned comment below. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.